It does appear that there is still money being spent by the consumer here. And I know we've talked a lot about the legacy of the COVID-related windfall, whether that was government support or whether it was the fact that you just didn't have to pay for things like transport and you stayed in your own home during the COVID crisis and saved money that way. How much longer is that money going to last, do you think, into next year when it comes to consumer-focused businesses?
Yeah, and it's interesting you say that because actually exactly what you're seeing in the UK is what has propped up the US economy as well. The US consumer has been incredibly strong. And as you said, it's a lot because that pandemic fueled fiscal stimulus really has helped households build up that cushion of savings. You are starting to see there in the data that that cushion is really declining. I mean, of course, it varies by income level, but you can see that in certain parts of the population, it is starting to decline to actually below COVID levels. And you can also see that credit card spending data is showing a very significant pickup in the last 3 or 4 months. So consumer spending is staying strong because people are still running down their savings and they're now dipping into their credit card balances. So what we would expect is that these strains are starting to build. It's difficult to know exactly when realization starts to hit, but because these strains are building up, at some point, varying by region, but I think for the United Kingdom, for example, where we are actually expecting the economy to perform the worst out of any of the major developed economies, this is something that we're expecting to hit really in the first half of this year. For the US, maybe they can go on a little bit longer because their cushion is somewhat larger, but it won't be sustained forever, which is why when we look at over 2023, we're saying, look, yes, generally the global economy was quite resilient last year, a lot more resilient than many economists, including us, were probably expecting. But it can't go on forever. So there will be, unfortunately, it's almost an unavoidable recession that we're looking at for major parts of the world.
Seema, as we talk about the global economy, I want to bring up the US dollar. I mean, mostly we had global economies battling the strength of the US dollar until about October last year, and then a fairly violent turn. Now, you point out that you're waiting for a convincing change in direction. Is it not convincing at this point?
So I mean, look, it has been a fairly significant shift lower, as you said, in the last 3 months. The thing is that when we start to look at the central banks, the Fed is still looking the most hawkish, right? It's moving rates a little bit further, has probably the most hawkish intent out there so far. So we think that there is still some upward pressure on the dollar, which could mean that you will see short-term bursts of strength coming through. So it's really about waiting for the Fed to pause, whenever that's going to be. Everyone's got different perspectives. From our perspective, it's around May. And come May, when they pause, that's probably your first clear signal for the US dollar to start weakening. So we are seeing that weakness, but we think it may not be fully sustained until you see that change in central bank policy, which would essentially be your green light for dollar weakness.
Seema, we're setting up for the minutes later on today, and the assumptions of the market are quite different. Some think we've got a rate cut coming by the end of this year, and others say it's really not going to happen until 2024. What's your view on just how stubborn inflation is in the United States at this point?
So there are parts of the US consumer basket which will be coming down fairly aggressively, and you will see deflation in parts of that. So we're thinking really food and energy, and of course core goods. So that's everything which with regards to supply chains as they're continuing to resolve. The part which is staying really sticky though is with regards to core services inflation. Parts of those are just typically sticky stuff like rental inflation, which are coming down, but they do take their time. But the other part of it is that core services is a reflection of that US consumer resilience. So we are expecting it to fade, but because the US economy has been quite strong and because it still does have that savings cushion, we might be looking through until the second half of the year. So that is a fairly slow decline for what is the most important part of the CPI basket from the Fed's perspective, because that's really where you get more pressure for wages. So from our perspective, yes, inflation certainly is going to come down, but we think it's going to plateau a little bit post the 4.5 level. So for the Fed, we don't think that will be enough to give them sufficient confidence to actually start cutting rates. So we are set firmly in the rate stay on no rate cuts for 2023.